Hello everyone. Our subject is auditing and assurance as per NEP 2020 from MCOM Part-2 Semester 4. Our question is, what are the main threats to auditor independence? Threats to the independence of auditor. Independence of auditor is fundamental to ensuring transparency, crucial role protecting stakeholders' interests by providing an unbiased assignment of a company's financial statement. However, various factors can compromise their independence, leading to ethical and professional dilemmas. In the India context, regulatory framework such as the Companies Act 2013, the Institute of Chartered Accountants of India (ICAI) Code of Ethics, the Security and Exchange Board of India (SEBI) guidelines, and the oversight of the National Financial Reporting Authority (NFRA) aim to uphold auditor independence. Dispute these safeguards corporate influence, financial pressures, regulatory gaps, and enforcement weaknesses continue to pose significant threats. The primary threats to audit independence can be classified into five categories. First, self-interest threat. Second, self-review threat. Third, advocacy threat. Fourth, familiarity threat. Fifth, intimidation threat. Okay, let's understand the threats to the independence of auditor. First, remember that auditor's job is to check whether a company's financial statement like balance sheets, profit and loss accounts are correct and fair. They should do this job honestly, without any pressure or personalities. In India, laws like the Companies Act 2013 and rules by ICAI, SEBI, and NFRA try to make sure auditors stay independent and do their job properly. But in the real world, auditors sometimes face pressures that can make them biased or less strict. These are called as threats to the independence. There are five main threats which we are going to learn. First, self-interest threat. A self-interest threat arises when an auditor's personal, financial, or business interest conflict with their financial responsibility to provide an objective and imperial audit opinion. This is one of the most prevalent threats in India, particularly due to the financial reliance of audit firms on their clients, which means self-interest threat happens when an auditor personal money matters clash with their duty to give an honest audit. In India, this is common because audit firms depend heavily on certain clients for their income. Next, factors contributing to self-interest threat in India. First, financial dependence on a single client, which means depending too much on one client for income. The auditor fears losing the client, so may not point out mistakes. Second, low audit fee and fee under continuity means low audit fee or price compensation. Auditors might cut corners just to keep cost low and win clients. Third, auditors holding shares or financial interests in the client's company, which means auditor owns shares in the company. This makes them biased because they will benefit with the company's does well. Fourth, contingent fees or for performance-based compensation, which means getting paid based on company's performance. If the auditor's fee depends on the company's profit, they may hide that risk. Our second point is self-review threat. A self-review threat occurs when an auditor audits their own work, leading to a potential loss of objectivity. This usually happens when auditors provide additional non-audit services, such as financial statement preparation or tax consulting, and later review the same work as part of their audit process, which means self-review threat happens when auditors have to check their own work or work done by their own firm. This can make them less strict because it's hard to find fault in your own work. Next, factors contributing to self-review trading in India. First, provision of non-audit services, which means auditor give non-audit services like tax planning and later audit the same account. Second, internal auditor becoming statutory auditor, which means internal auditor becomes statutory auditor, they might not question their own work. Third, long-term audit engagement without rotation. Auditor work with the same company for too long, leading to comfort and carelessness. Fourth, regulatory safeguards in India. Laws like the Companies Act 2013 stop auditor from giving certain services and require them to rotate after some years to avoid this threat. Our third point is advocacy threat. An advocacy threat arises when an auditor promotes or defends a client's position, leading to compromised independence, which means advocacy threats happens when auditors stop being natural and start behaving like the company's supporter or lawyer. This makes them biased and they might ignore mistakes to protect the company. Next, factors contributing to advocacy threat in India. First, representing clients in legal disputes, which means if the auditor helps a company in tax cases, court matters, or regulatory disputes, they act more like the company's lawyer. Example, if an auditor defends a company in a GST case, they might feel pressure to hide tax-related mistakes during the audit. Second, lobbying for client in regulatory approvals. If the auditor helps the company, government approvals, tax benefits, or subsidies, they may become biased because they are actively supporting the company's interests. Next, regulatory safeguard in India. First, ICAI Code of Ethics, which means clearly says that auditors should not act as advocates for their audit clients. Next, second, SEBI regulations. SEBI regulations are strict to the auditors and also auditors of listed companies from doing such advocacy work. Our fourth point is familiarity threat. This threat arises when an auditor becomes overly close to a client, leading to a biased audit opinion, which means when the auditor becomes too friendly or close to the company or its people. When this happens, the auditor may stop being strict or ignore the state because of personal comfort. Next, factors contributing to familiarity trade in India. First, long-term relationship with client means if an auditor works with the same company for many years, they may become too comfortable and stop being fully objective. Second, employment of former auditor in senior management, which means if someone who was an auditor joins the company as the director or senior officer, the new auditor might find it hard to challenge. Third, personal relationship with promoter or director means if the auditor has personal or family relations with the company's owners or directors, it affects their independence. Next, regulatory safeguards in India. First, mandatory rotation of auditor prevents long-term familiarity, which means mandatory rotation of auditor as per Companies Act 2013 makes sure auditor doesn't stay with the same client for long period. Second, cooling off period. Before a former auditor can join client's company, which means a former auditor must wait for some time before joining the client's company in a senior role. Our fifth point is intimidation threat. An intimidation threat occurs when an auditor is pressured by the client or external entities to modify audit findings, which means it happens when the auditor is scared or pressurized by the client or other to change or maybe hide audit findings. This can make the auditor or afraid to report the problems honestly. Next, factors contributing to intimidation trade in India. First, pressure from promoters in family-owned business, which means pressures from promoters in family-owned business. In many Indian family-run companies, powerful promoters may directly pressure the auditor to avoid reporting negative issues. Second, threat of legal action or contract termination, which means threat of legal action or ending the contract. Companies might threaten to fire the auditor or take them to the court if they report something unfavorable. Third, regulatory and political influence in public sector companies, which means Political or regulatory pressures in public sector companies. In government-owned companies, other auditors may face pressures from political figures or might be from senior officials to adjust audit reports. Next, regulatory safeguards in India. First, whistleblower protection under SEBI regulations. SEBI regulation provide whistleblower protection so auditor can report threats or unethical behavior safely. Next, second, NFRA for independent review, which means NFRA, National Financial Reporting Authority, oversees audit and ensures that auditor can work independently without fear.